$4,000 per ounce. Gold just blew through a threshold that many analysts on Wall Street said was 5 years away. The commodity has now more than doubled in just 2 years. We've seen 41 record highs in 10 consecutive months. There are videos circulating online of people queuing around in lines around city blocks in Singapore, Vietnam, and Australia. They're waiting hours on end outside gold dealers, looking to buy the commodity hand over fist. The price keeps climbing, but instead of scaring buyers away, it's pulling more of them in. If we look back through history, we see that every time gold more than doubles in the reserve currency of the day, it's a harbinger that something serious has broken. Rome started clipping coins and mixing copper with silver to fund their endless wars. As the denarius, the Roman currency, became worthless, gold became priceless. Spain discovered mountains of silver in Peru and Mexico, convinced that they'd unlocked infinite prosperity. Instead, they destroyed their economy as the peso debased. Gold rocketed higher. In the late 1700s, France invented modern paper money, calling it the assignat, and printed it into oblivion to fund their revolutionary government. The paper became so worthless that Napoleon himself found citizens using it as wallpaper. Gold soared. This pattern is repeating right now. But you may be thinking, we've had inflation before. The Fed printed trillions after 2008. Money supply exploded during COVID. So why is the gold price moving now, but not back then? Because for decades, the central bankers have actually been able to suppress it. The global gold market is essentially two markets pretending to be one. The first market is the physical. This is actual gold. Bars you can touch and metal you can melt. It exists in vaults from Zurich to Shanghai. The Shanghai Gold Exchange, which is the world's largest physical gold exchange, did 24,198 tons of physical gold in 2023 alone. The second market is what's known as the paper market. This is the promise of gold, and it includes futures contracts on the COMEX, unallocated accounts in London at the LBMA, and ETFs that may or may not have the metal that they claim to hold. The price you see on TradingView isn't determined by supply and demand. It's set by these paper contracts traded on Western exchanges. The COMEX opened in 1974, right around the time Nixon closed the gold window. That timing isn't coincidental. When currencies stopped being backed by gold, governments needed a new way to manage the metal's price. The futures markets gave them the perfect weapon. The way it works is, say you're a gold mining company producing 1,000 gold bars per week. You need steady, predictable cash flows to cover the costs of your mining operations. And the problem is, volatile gold prices make budgeting near impossible. So you approach a bullion bank like JP Morgan and create what's known as a forward contract. This means they agree to buy your gold at a predetermined price week after week, giving you the cash flow and the stability that you need. But now, JP Morgan has positive gold cash flow. That's a risk. If gold prices spike, they're buying at above market rates and losing money. If gold prices fall, then the value of their gold bar shipments fall as well. They need to hedge. So they short sell paper gold futures on the COMEX. Now they're market neutral. Over time, JP Morgan realizes something interesting though. Only about 1% of futures contracts result in physical delivery. Everybody else settles in cash. And that creates an opportunity. Why maintain a 1-to-1 ratio between physical gold and paper contracts? If only 1% take delivery, then you can sell 100 paper ounces for every physical ounce of gold you hold. As long as nobody asks for their gold, you print money with minimal risk. And that means that 99% of gold demand is routed through the paper markets and never actually touches the physical metal. Investors looking for an inflation hedge are only buying derivatives. Structurally, this means gold prices barely budge, even if massive buying pressure comes in from retail traders. And it gets worse. The incentive to manipulate runs deeper than just selling more gold contracts than what you actually have. VBL, a gold market veteran with decades of experience on Wall Street, explained this dynamic in detail, stating that banks front-run their own business constantly. Imagine you have two banks, both with the same client, Newmont Mining. When the mining company calls one bank and says that they want to sell a large gold shipment, the trader messages his friend at the other bank. They both know that the company's getting ready to sell, so they start dumping for their own books before Newmont even executes their trade. It's like two football coaches who hear that a star player is injured before the public announcement, so they both rush to change their bets before the odds adjust. This is what VBL calls the RICO aspect of the gold market. Banks know that miners are predictable sellers because they need to sell regularly to fund their gold operations. So banks short gold ahead of these sales, pushing prices down, and then cover their shorts when miners actually sell. It's beautifully cynical, and it's been happening for decades. Between 2008 and 2014, traders at Deutsche Bank, JP Morgan, and other major banks ran a scheme they called the cartel. They manipulated gold prices for 6 years straight. When they finally got caught, the fines totaled nearly $1 billion combined. Michael Nowak, who ran JP Morgan's precious metals desk, and trader Greg Smith were convicted of spoofing, which is placing fake orders to move prices. The sentence for manipulating markets for almost a decade was only 1 year for Nowak and 2 years for Smith. And the gold market is of course manipulated by nation-states as well as banks. In the 1960s, the United States and 7 other nations formed something called the London Gold Pool. The purpose of the system was to keep gold at $35 per ounce in order to maintain the 1944 Bretton Woods peg. Due to the Vietnam War, spending doubts were arising that the US was really remaining faithful to that peg. In 1965, France's Prime Minister Charles de Gaulle ultimately called the bluff. He started demanding physical gold for dollars, and suddenly everyone else wanted their gold too. The pool collapsed in 1968, and 3 years later, Nixon was forced to close the gold window entirely. This famously moved the world to an era of fiat money and floating currencies. Today, that gold pool looks much different. What we have instead is the paper market that dilutes physical demand through infinite synthetic supply, allowing the banks, dealers, and governments to control the price as they please. According to the anonymous blogger known as Another, who wrote about this extensively in 1997, Western central banks made deals with bullion banks to sell paper gold certificates, which represented real gold. This added massive selling pressure to exchanges and suppressed the gold price for decades, until a large trader out of Hong Kong realized what was happening and began demanding physical delivery. That trade started a trend that would eventually break the Western paper markets. Enter the Shanghai Gold Exchange, which unlike COMEX or LBMA is primarily a physical market. The international portion of the exchange was founded in 2014, and trading volumes have been climbing steadily since then. When you buy gold in Shanghai, you get gold. Not a promise, not a certificate, but the actual metal. Because of this physical settlement and strong gold demand within China, prices in Shanghai began to rise far above Western paper markets. This trend accelerated during COVID, and the delta between the two went up exponentially. This fundamental difference created an arbitrage opportunity that would drain the Western vaults. Traders could buy COMEX futures at New York prices, demand physical delivery, ship the gold to Shanghai, and then sell at the premium, which was often $50 to $100 per ounce. This could pocket them massive profits. This arbitrage had started draining massive amounts of physical gold from Western vaults. COMEX, which was designed to trade paper, not deliver metal, was hemorrhaging physical gold at an unprecedented rate. Average monthly deliveries were 200 to 400% the historical norm. Over 36 tons of gold flooded into Shanghai warehouses in just a matter of months. The paper market's bluff was being called on a massive scale, and central banks around the world were taking notice. And they should, because just a few years earlier, the entire financial system had been put on lockdown. February 26, 2022, the G7 nations make an unprecedented move that sends shockwaves through the global financial system. In response to the Russian invasion of Ukraine, authorities freeze almost $300 billion of Russia's foreign exchange reserves. Money that Russia thought was theirs, held in Western banks, suddenly wasn't theirs anymore. This was the shot heard round the central banking world. If Russian reserves could be frozen, so could everyone else's. Every country on the planet suddenly had to consider a fundamental question. Is our money really ours if someone else is holding it? The response was immediate and massive. In 2022, central banks purchased 1,078 tons of gold. In 2023, they bought 1,045 tons. In 2024, they purchased over 1,000 tons again. 3 consecutive years of purchases exceeding 1,000 metric tons, something that hadn't happened since nations were on a gold standard. And the first quarter of 2025 revealed something extraordinary about who's actually driving this gold revolution. It's not random buying across the board. The same emerging market central banks that started this trend are now accelerating their accumulation at an unprecedented pace. The National Bank of Poland, which led the charge last year, has gone into overdrive. They added 49 tons in just the first quarter alone, which represents 54% of everything they bought in all of last year. The Czech National Bank added another 5 tons in the first quarter, and their accumulation has increased holdings to 56 tons. India's Reserve Bank added 3 tons in the first quarter. Last year, they bought gold every single month except December. The Middle East is quietly joining the party. Turkey continued its relentless accumulation, adding another 4 tons based on the available data. Qatar added 3 tons, and Egypt added 1 ton. While these might seem like small numbers, remember that these countries are choosing to convert their oil revenues into gold rather than keeping them in dollars or treasuries. But the biggest chess move comes from an eastern rival. The People's Bank of China reported adding 13 tons to its reserves in the first quarter, bringing their reported total to 2,292 tons. That pushes gold to 6.5% of their total reserves. But these are just the official numbers. Between the domestic mining output that never leaves the country, the imports flowing through Hong Kong that vanish into the mainland, and purchases made through an elaborate network of proxies and commercial banks, China has been hoarding gold with an intensity that suggests that they know something the rest of us are only beginning to understand. Yan Nguyen-House at the Gold Observer has spent years doing forensic accounting on Chinese gold flows. He's been tracking shipments, analyzing customs data, and connecting dots that Beijing desperately doesn't want connected. His conclusion is explosive. China's actual gold reserves likely crossed 5,000 tons back in 2023, which would make them the world's second largest holder after the United States. The methodology he uses is brilliantly simple once you understand how the game is played. The People's Bank of China acquires gold abroad using dollars and ships it directly to Beijing through channels that don't leave customs traces. You can't track these purchases through normal reporting mechanisms because they're designed to be invisible. We know that they're doing this because there's always a gap between what the World Gold Council estimates as total central bank purchases and what central banks officially report. That gap represents shadow demand. This is overwhelmingly China buying gold through London and Swiss banks while maintaining the official fiction that they only hold a bit over 2,000 tons. Let me give you a concrete example of how massive this hidden buying really is. In the third quarter of 2022 alone, the World Gold Council reported 459 tons of central bank buying, but only 109 tons were officially declared by all central banks combined. Where did the other 350 tons go? They didn't evaporate. Nguyen-House estimates that 80% of these unreported purchases are China, operating through their shadow channels. That would mean 280 tons in that quarter alone. And this isn't just speculation. Mark Bristow, the CEO of Barrick Gold, one of the world's largest gold miners, confirmed this to the Financial Times. He said that China had bought in the high 200s that quarter, based on discussions with industry sources who should know. And here's where the numbers become truly staggering. If China holds 5,029 tons officially, and if you add the 24,690 tons held privately by Chinese citizens, we're talking about nearly 30,000 tons of gold within the Chinese borders. Let that sink in for a moment. That's more than the entire gold reserve of all Western central banks combined. And remember, China is also the world's largest gold producer, mining 370 tons annually. Not 1 ounce of that domestically mined gold is allowed to leave the country. Every single ounce mined in China stays in China by law. It's a one-way valve that only ever allows gold to flow in, never out. And why would China and other global central banks hide their gold purchases? Because they're preparing for something that they don't want to advertise. They see what's coming, and they're positioning accordingly. To truly understand what they are preparing for, we need to examine the elephant in the room. Global debt has reached $280 trillion. That's 356% of global GDP. To put that in perspective, that's $34,000 for every human being on Earth, including newborns in the poorest villages of Africa. But here's the part that should terrify everyone who understands mathematics. This debt can never be repaid in real terms. The numbers simply don't work, and they haven't worked for a long time. Let's use the United States as our example, because if the US system breaks, everything breaks. The current debt stands at $38 trillion with an annual deficit of $2 trillion. Interest payments alone are now $1 trillion annually, while GDP growth averages just 2% per year. This means that deficits are running at a steady 7% of GDP, and interest expense is already past 3% of GDP. If this continues, soon interest expense will eclipse all tax revenues taken in by the IRS. Lynn Alden, one of the most astute macro analysts working today, puts it bluntly when she says nothing stops this train. The deficits are much more intractable than the optimists think, meaning that it's not likely that Congress is going to be able to get them under control anytime soon. It's a very long, slow-motion train wreck. Because of this, the Federal Reserve faces an impossible choice that economists call the fiscal dominance trap. If they raise rates to fight inflation, government interest payments explode into a fiscal crisis. If they keep rates low, then inflation runs hot and we get a currency crisis. There's no way out. They'll choose the second option because they always do. The alternative is immediate catastrophe versus a slow-motion debasement. Ray Dalio calls this the beautiful deleveraging, where you inflate away the debt through currency debasement while keeping real interest rates below inflation. It's wonderful for debtors, but outright theft for savers. Morgan Stanley's recent data is absolutely stunning. The US dollar ended the first half of 2025 with its biggest loss since 1973, declining 11% in just 6 months. This is the dollar's worst performance in 52 years, and it's happening while the US economy is supposedly strong. Foreign holders of US government bonds, who collectively hold over $9 trillion worth, are watching their holdings evaporate in real terms. Most of that is unhedged. When these foreign investors start hedging, which Morgan Stanley says has already begun, it becomes a self-fulfilling prophecy. Hedging means selling bonds. Selling bonds means a lower price, and a lower price means more hedging is needed. It's a doom loop that feeds on itself. Perhaps this is why, in 2025, for the first time since 1996, central bank gold holdings eclipsed U.S. Treasury holdings. This represents a massive sea change, a paradigm shift in the global monetary system. The debt of the American government is no longer the de facto store of value for foreigners. But the gold price is telling us more than just central banks reacting to a U.S. fiscal crisis. It's forecasting what comes next. When you look at the research, gold consistently front-runs waves of quantitative easing by around 12 to 18 months. Let's trace this pattern through recent history. In December 2018, gold began rising mysteriously at $1,200. There was no crisis, no QE, just steady accumulation. 15 months later, in March 2020, we get massive QE in response to COVID, and gold hit $2,070. In August of that year, gold peaks and starts declining. It traded flat and down for almost 2 years. Then, in March 2022, about 18 months after the peak, the Fed starts tightening, just like the falling gold price had predicted. In February 2025, gold begins its current rally at $2,800 and has since went up by almost $1,300. If this pattern holds, and it has held for decades, we're about to see massive monetary expansion in the first or second quarter of 2026. Central banks clearly see this wave of debasement coming, which explains their desperate accumulation. But there's another factor that most analysts miss, and it's the physical constraint problem. Annual gold mine production is just 3,300 tons, while annual gold demand in 2024 was 4,700 tons. We're already in a deficit of 1,200 tons before any investment demand kicks in. When pension funds, sovereign wealth funds, and institutional investors really start allocating to gold, and they will, where does that supply come from? It doesn't come from anywhere. Price is the only adjustment mechanism in a market where supply is essentially fixed, but demand can expand infinitely. Goldman Sachs sees this clearly, forecasting gold will reach $4,900 per ounce by the end of 2026. TD Securities is even more aggressive, saying that if China accelerates its buying, gold prices could move towards $6,000 to $7,000 an ounce. Bloomberg Intelligence's Mike McGlone has already called for $7,000 gold in 2026. But these aren't gold bugs making these predictions. These are mainstream financial institutions, and they're all reaching the same conclusion through different analytical paths. And this is just the tip of the iceberg. Shockingly, institutional allocation to gold is essentially zero. The average pension fund has less than 1% allocated to gold. Most have none. Insurance companies have none. Endowments might have 1 or 2% if they're particularly progressive. Self-custody has never been more important. And that's why Blockstream created the Jade Plus hardware device. It's the simplest and most secure way to store your Bitcoin, and it sets up within minutes with easy, intuitive design and a step-by-step guidance system. Pair it with the Blockstream Green app on mobile or desktop for a seamless experience, and unlock advanced features as your stack grows, like the air-gapped Jade Link storage or QR code for secure cable-free transactions. For max protection, Jade Plus also supports multi-sig. Don't wait, take control of your Bitcoin today. Get the Blockstream Jade Plus using the link in the description down below and use code PB10 to enjoy 10% off and to support this channel. Global pension assets sit at $56 trillion. Now imagine what happens when these institutions move to a just 5% gold allocation. The math is staggering. 5% of $56 trillion is $2.8 trillion. The current value of all investment gold is about $3 trillion. These institutions would need to nearly double the entire investment gold market just to get to a 5% allocation. Where does that gold come from? Annual mine production at current prices is worth $436 billion. It would take 6 years of the entire global gold production just to meet pension fund demand at a 5% allocation, and that's assuming that nobody else wants any gold for any other purpose. Bank of America's research is unequivocal on this trend. High net worth investors surveyed have nearly doubled their allocations to gold in the past year. The smart money is moving first. Institutions always follow, and when they do, the price impact will be violent. The market dynamics are reaching a breaking point that will require a massive price adjustment to clear the market. And this is going to be forced by the changing macro regime. The global sovereign debt crisis isn't coming, it's already here. Japan's debt is at 255% of GDP. America is at 123. France is at 110. The UK sits at 104. Every major economy is functionally insolvent. They survive only through financial repression, keeping real rates below inflation to slowly default on creditors through debasement. But here's what breaks the game permanently. Once creditors realize that they're being defaulted on through inflation, they stop buying bonds and start demanding real assets like gold. 81% of central bankers now expect their gold reserves to increase over the next 12 months. This isn't divergent thinking. This is consensus. Central bankers globally are preparing for the same thing, which is the end of the pure fiat experiment. And they're doing this while the globe remains woefully underallocated to gold, especially by historical standards. Since 1980, the ratio of gold to M2 money supply bottomed out at around 2. The historical average sits between 8 and 10. During monetary stress, that ratio has spiked as high as 17 to 20. Right now, we're only at 6. If the ratio just returned to its historical average, that means we're looking at $8,000 to $10,000 per ounce. And if we hit anything resembling the monetary stress of the 1970s, gold hits $24,000. But when we look through the lens of government debt as opposed to money supply, the numbers get even more extreme. In 1934, after Roosevelt revalued gold, U.S. gold reserves represented about 26% of national debt. In 1980, at the peak of the last great gold bull market, that ratio was 26.5%. Today, U.S. gold reserves represent a mere 3% of all outstanding government debt, the lowest level in 90 years. To return to 1970's gold-to-debt ratio of 26%, the price would have to be $36,000. Gold would have to 9x from here. In any regard, prices would have to go much higher. In conclusion, what we're witnessing isn't a gold bubble. It's not speculation. It's the largest monetary regime change in half a century, happening in real time while most people remain completely oblivious. Central banks have accumulated 3,000 tons in 3 years, but they're just getting started. Shanghai is draining Western vaults, and the arbitrage is accelerating. The dollar has fallen 11%, and the math guarantees further debasement. We're just getting started. And the smartest investors in the world are now positioning for the same outcome. Ray Dalio says cash is trash. Paul Tudor Jones says he wants to own gold. Stan Druckenmiller says he doesn't see how we avoid inflation. These aren't gold bugs or conspiracy theorists. They're billionaires who understand math, and the numbers are completely inescapable. Debt that can't be repaid won't be repaid. Currencies backed by nothing eventually return to nothing. The revolution isn't coming. It's here. It's just not evenly distributed yet. When historians write about this period, they'll mark 2022 as the turning point, the year Russia's reserves were frozen, the year central banks began to revolt against the global dollar system. But the real turning point is when ordinary people realize that their money is being systemically destroyed, when they understand that gold isn't the speculation, it's the lifeboat. A new financial revolution has begun. The only question is whether your portfolio will survive and thrive, or if it will burn into oblivion, like hundreds of fiat currencies before it.
Suspend temporarily the convertibility of the dollar.
As a central bank, we have the ability to create money.
We've had an 8-day losing streak in the Dow.
Inflation is our friend.
It's a tough problem.
The question is, how long will this go on?